We had a crazy day on Friday. Many stocks like Nvidia down over 10% on the day. Meta was down 4%. A lot of other semiconductors were also down. Amazon was down 2.5%, which I'm excited about because I've been waiting on Amazon. I kind of missed buying the stock. I want to buy the stock. Down another 2.5%. Good news for me. Tesla continued to go down, of course. But the interesting part is that a lot of the defensive stocks, healthcare companies, banks, and Coca-Cola, Pepsi, Procter& Gamble, many others have shown some signs of life on Friday. I think it's because more people are believing that we might have a recession, and this is causing people to rotate out of the Magnificent Seven stocks, out of cyclical semiconductor stocks, and going into safety stocks. AT&T and Verizon were up, tobacco stocks were up. So it's been a crazy rotation on Friday, and I'm not sure if will continue. But I've done many of these videos over the last few weeks, and we talked about what was happening, and we talked about the possibility of going to 4,800 when the S&P was at 5,200. And if you've been watching the videos, you know that this has played out correctly. I'm not saying that it's always going to play out, but this time it has played out correctly in the videos. But I personally believe that this pullback is close to being over. I believe stocks are pretty close to bottoming out, and I think the trend is going to shift to the upside very, very soon. I'm going to tell you why in the videos. I always talk about things that most people, they don't maybe agree with me, or things that is not very popular, but this is why we've been accurate more than not being accurate, because we tend to get a different view from what the crowd is actually thinking about. But a lot of the excess is starting to get wiped out, like SoundHound.ai, which we talked about. This is a stock that went up just because Nvidia bought a stake. Now it's down 55% on the month. Crazy. Even the indices are pulling back. The S&P 500 went from being up 9% on the year to only up 4.7%. The Nasdaq 100 was up pretty close to 11% on the year, and now it's only up 2.9%. Even my portfolio, I was up 33% on the year, and now I'm up pretty close to 21%. But I take these pullbacks as amazing opportunities to be buying a lot of stocks at fair value or pretty close to undervalued. And I don't think we're there yet, but I think we're getting very, very close. And there's two reasons why I believe this pullback is getting pretty close to ending. The first one, which we focus on in the videos, and a lot of people don't focus on this, and it's mainly sentiment. The best thing I got from being on YouTube and being on Twitter, I tell you this before, but a lot of you don't believe me, but it's mainly the sentiment, the feedback. Whenever people are trying to make fun of me whenever I do a video, I know I'm gonna be right. Most of the time I make more money whenever people don't agree with me. But whenever a lot of people agree with me, this is when I tend to be wrong. It's crazy. And even being on Twitter, if you see a lot of posts on Twitter, bearish posts, it's always feel like we're pretty close to the bottom. It's always the same thing. People start calling the 2008 financial crisis as soon as we start going down a few percentage points. And this normally means that we're about to get another reversal. It's not this easy. It doesn't work every time. But sentiment is very, very powerful. And a lot of people don't take it into consideration. And in terms of the fear and greed index, which is not the best, but now we're sitting at fear territories. We haven't been there in a while. We're getting pretty close to enter extreme fear territories. If you look at this very nice chart, we bottomed in October in extreme fear around 23. And now we're sitting pretty close to, I think, around 31, which we're getting very close to entering the extreme fear territories. The second thing I'm seeing in terms of sentiment is mainly a lot of posts on Twitter. I'm not saying anything around this person or this post specifically. I've seen a lot of them, but we start going down. People start looking for some kind of picture, some kind of thing of why we're gonna go down more, of why they shouldn't be buying stocks, of why we're gonna go lower, maybe because the Fed's gonna, cut rates, and after the first cut we go down, or all kind of things around to justify why we're going lower, why we're gonna have another 2008. And this post pretty much says that if we stayed inverted on the yield curve more than 500 days in a row, we get around a 50% drawdown in the S&P 500. And I hope this is true because it creates amazing buying opportunities. But again, I'm not seeing it. But I'm seeing the sentiment shifting negative. I'm seeing more and more people not buying because they believe the market is going to be going lower. I'm seeing a lot of people just justifying of why the market is going down, why they shouldn't be buying stocks, why it's going to get worse than it is. And normally once these things start happening, we're likely pretty close or near a bottom in sentiment. And I'm going to show you some charts a little bit later. But the second reason why I believe we're pretty close to some kind of a bottom in the S&P or in most stocks in general is mainly because of valuation. And this is an older chart. This is on April 12th. So now the forward PE ratio is much, much lower. But this is the forward PE ratio on the mega cap 8. And now it's sitting around 28 times. This is on April 12th. So now it's around 25 to 26 times. But if we assume it's around 26 times, now if you look at it on 26 times on the historical average, pretty much since 2019, 2018. It's a little bit elevated, but it's not crazy elevated. It's not the cheapest multiple ever, but it's not crazy elevated for the profit margins that a lot of these companies are putting up. Now, a lot of you will tell me, yes, but this is very expensive because we have 5.5% interest rates and we did not have 5.5% interest rates before. This is true. But as I said, the market is forward looking. And the market's always trying to find a reason of why rates will go lower. The market and investors at Wall Street, they want interest rates to come down. So unless everyone stops believing that interest rates are going to come down, then yes, we're going to have a massive stock market crash. But as long as investors believe or have some kind of hope that interest rates are eventually going to come down, they will invest according to this view, which is why a lot of times things don't bottom whenever it's obvious. Nothing perfect happens in the market. Oh, 5% raise, that means the multiple has to be here and I'm not buying the stock. A lot of people missed out on so much upside just because they were buying a multiple that was the same multiple in 2019, but now we have 5% interest rates. In 2019, we had, 0% interest rates or around 1%, and they didn't buy it just because the multiple is the same as it was before, and it should be lower, but it's not lower, and the stock goes up 50% to 100%. A lot of times, things are not ideal in the market. They don't just happen 1 + 1 = 2. And especially within Wall Street and most investors, they're always going to find some kind of reason of why interest rates should be going lower. And as long as they believe that, maybe a year or two from now, and it is eventually going to happen, I think the Fed and everyone, they don't want 5% rates forever. And I think around 25 to 26 times for something like the mega cap or Magnificent Seven stocks, I don't think it's extremely overvalued for this index. The second thing is stocks like NVIDIA. NVIDIA was a darling of AI, and I still believe NVIDIA is somewhat overvalued. But now NVIDIA is sitting around 30 times earnings. And 30 times earnings has been historically a very fair multiple for NVIDIA. So NVIDIA is not as overvalued as it was before the 10% drop and before the drop it had before, especially if it does beat, or it does at least beat, the guidance, which is extremely bullish, around 92% EPS expansion in 2025 and 20% 2026, 20% 2027, and 35% in 2028. NVIDIA has historically been beating EPS, and it has been beating revenue and a lot of different profit guidance that they had. I'm not sure if they can do it again, but it will largely depend on mainly growth, revenue growth, or EPS growth for a lot of these companies. So it's not much about a multiple contraction. If they can meet the EPS growth that they have, I don't think most stocks are extremely overvalued at current multiples. Even the S&P 500, it does look overvalued on a forward PE ratio, which is a little bit high. But if you look at it on a PEG ratio, which is a PEG ratio, price to earnings growth, it's not as expensive as you think on a historical basis. But this is only if they can actually hit these earnings growth numbers. I think a lot of the cyclical stocks might not hit it because we're having weakness in the retail sector. But a lot of these Magnificent Seven companies are amazing companies, as they might be able to hit or even exceed these numbers. So for me, the sentiment is getting pretty close to bearish or extreme fear territories. I don't think we're there yet. I think most valuations are not extremely exaggerated. I think most of them are reasonable. And this is a chart of the S&P 500. We've talked about this since the S&P was pretty close to 5,200. We broke below the trend line, and I talked about the possibility of us going to 4,800, where there's a line of support, and looks like we're getting pretty close to 4,800. It's around 3% away. And for me, looking at it, 3% away is like 5 or 10% or 15% for a lot of individual stocks. And it would take us pretty close to the extreme fear territory on the Fear and Greed Index. If you look at the RSI of the S&P, we're at 31, which is pretty close to oversold. If we go down another 3%, we will be in oversold territories. And this is when the S&P 500 tends to bounce. So everything to me is lining up for another 2 to 3% decline in the S&P before we bottom on stocks, which would lead me to believe that a lot of the stocks that we're talking about are pretty close to bottoming out. I don't think we're going to have another 2008. I've talked about it before. I'm going to talk about it again. And this is a 10-year minus 3 months. It's been the most accurate indicator ever for predicting recessions. and it's been reinverting lately on the way, but it's nowhere close to being positive. And historically, we only had something bad happen in 2008, 2000, and many times before after we went positive, like 5 or 6 months after turning positive. And now we're far away from turning positive. So my outlook was on the S&P for 2024, and most of you guys know this, that we will have some kind of a pullback to price in the possibility of us having no rate cuts for 2024. And this is exactly what's happening. The S&P is sharply pulling back. A lot of stocks are down way more than the S&P, and we're pricing in the possibility of having no rate cuts for 2024. Now, if we do turn positive on the yield curve in late 2024, I would expect the crash to happen in 2025. And to me, this is the most idealistic scenario. Maybe it's not going to happen. Maybe I'm wrong again. I've been wrong before, and I've been right a lot of times too. But this is what I think. I don't think we're going to have a massive crash right now or a 2008 crash right now. I think we'll continue pulling back another 2-3%. I think stocks are pretty close to bottoming out. And this is my thesis on the market. And then if we do turn positive on the yield curve, this is when I would be a little bit worried that something bad could happen within 5 to 6 months, like it happened with over 100% accuracy. And this is my opinion on the S&P and the market update in general, not financial advice. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.